Hello, welcome back to Your Money in Real Estate. We're going to get into the best section of the show, which is I like the most, which is we're going to get into some numbers. We're going to get into talking about alternative investments from an actual standpoint, because we're sort of dancing around a lot of different concepts. And during the break I thought, you know what, why don't we sort of break down how someone, any one of our viewers out there can take, let's say I'll start off with $25,000.
Sure.
And so someone has $25,000 and they want to put it into some real estate investment. How would they go about that? Well,
sure. I think so. The first question goes, okay, I've got $25,000. Where is it going?
Right.
Where is it going? And so let me give you an example of one of the companies that we deal with that deals specifically in real estate, and they're named Fortress Real Capital.
Okay.
And they're a group that goes out and allows investors to be able to invest in the profitability of development itself. So I'm not talking about buying a condo unit and then selling it, but developers themselves do quite well.
Sure.
So they do very well when they go out. We don't.
Okay.
And so there's some profitability in there. So give you an example of what that would look like. We did a project in Ottawa just recently, and they were able to purchase the land. Developer wanted to build the building,
okay,
but needed some funds to get it from I've purchased the land to let's get it started, right? They need to get pre-sales and all these things in place.
And in comes Fortress?
In comes Fortress with our investors together, syndicated together.
Okay, so I've got 25K. Yeah. Where does it go? It goes to Fortress, and how does it?
So
how is it secured? Where, like?
Yeah, so it goes to the developer. And what they do is they actually take a mortgage against the property.
So in this particular case, you're saying it becomes a mortgage. It doesn't become an equity. It becomes a debt.
It becomes a debt. Yeah.
Okay, so we're looking at. I'll just do mort.
Okay.
To make it simple. So your 25K becomes a mortgage.
That's right.
Explain a little bit about what that is then.
So the developer's gone and he said, okay, we're going to go build this building and we're going to make some profits from doing it.
Okay.
But, and I need the funds to do it.
You bet.
But capital preservation, and what I mean by that is protecting your nest egg, protecting your money.
Bingo.
Is the most important thing. So how are we going to secure that money against the asset? You got it, which is that mortgage.
Okay, so but the word is secure.
That's right.
We need our money secure. We need this secured.
Yeah, what are we going to do to ensure that he just doesn't walk off with the $25,000?
That's it.
Or what are we going to do to ensure that
I just put in 25 into a mortgage? Well, what the heck is it? What does that mean? Like it's floating out there somewhere.
But just like the bank does, right? They're happy to lend on real estate again because they know that if you get in trouble or you don't pay your mortgage or you don't pay that fixed return that they've set for you to pay, guess what? They take your house and they sell it. It's the same thing here. We have a mortgage against the property. If the developer does not pay what he should be paying, and that's fixed ahead of time, so in this case they pay an 8% mortgage rate.
Okay, so you mentioned a couple of things. I put in 25K, a very particular project. Let's say I like Ottawa, and I like that 25K goes in a mortgage. Does that mean that my 25K is secured by the land or by the building, or how is it like?
Yeah, so it's just like a mortgage would be. It's secured by the value of the property itself.
And if the developer for whatever reason doesn't pay his mortgage,
that's right,
we as an investor can go in and say, I get the land back, like a bank.
And the nice thing is that you, the investor, don't have to do that if that were the case. So there's the product provider, the investment itself, that's their job. They take care of all the details for you. You're essentially investing. This could be RSP money as well. You could be just moving existing RSP money.
Okay.
By the way, when we talk about using registered dollars, this doesn't mean that you have to make a new contribution in your RSP.
What do you mean?
Well, it doesn't mean you have to add more money to your RSP. It doesn't mean that you know how you do your yearly contribution into your RSP. That doesn't mean that you have to add more. All you can simply do is just transfer some of your existing RSPs. So let's say just happenstance that somebody has $100,000 total in their RSP.
Okay.
Well, maybe they want to move $25,000 into another product. It's just like going from mutual fund A to mutual fund B.
You don't have to take the whole amount. You can just take portions of it?
Sure, yeah. And so you can just take a portion and it's essentially the same thing as you've done or your advisor's done for you a million times before. It's just moving it from one fund to another fund.
Got it.
So if you're thinking this is complicated, it's hard to do and all the rest, it's not.
Okay.
It's simply just moving it from one investment to another investment. Just so happens that these are called alternative investments. We've made it now, and legislation has helped that make it so that it's just about as easy as it would be investing in a mutual fund or something like that.
Well, earlier you said that, okay, the 25K obviously doesn't supply everything that the developer needs. So the developer needed 20 million. So my 25K is a drop in the water, and I'll use that word. It's in a giant pool.
That's
okay?
right.
So when we talk about it being secured, so that pool is given to the developer. So my 25K, like when you say it's registered, does my name go on title? How does that work? Like, or is
It
the pool?
depends on the company. So if we use the example with the Fortress Real Capital again, in that case, yes. Yeah, you actually you have a mortgage. It's called a syndicate mortgage.
Okay.
A group of mortgages together. So that word syndicate again just means, if you get stuck on that, it just means group together.
Okay.
So replace that with group together.
Okay.
And it's a group of mortgages essentially. So yeah, the name goes right on the title there.
Wow. And
And it's sold by a licensed mortgage broker.
And Fortress is managing the whole thing, so they would be considered. Do they get MER fees just like a mutual fund? How are the fees working for that? Or
It's
is
neat.
there fees?
It's interesting. So one of the principles we look at is we want to make sure that the company or the investment company is aligned with our investors. And what I mean by that is we don't want them making any money if our investors don't make any money. And we only want that, we don't care how profitable they are if our investors meet their objectives, right?
Okay.
And so they make the majority of their funds based on the completion of the project if it goes well, right?
Okay.
Which we're happy as investors because we want them to want the project to go well.
Well, just like a reason why someone invests in a development is not just to make a flat interest rate. They can get that at a bank. You want to say, I want a piece of the pie of what the developer's making, and you're saying that this mortgage will do that as well?
That's correct.
Wow.
That's correct. So you have security against the property through the mortgage.
Right.
And
you have a piece of the pie.
That's right. So some of the questions that we hear sometimes is say, okay, so it's in there. How long do I need to invest it for?
There's a good question, yeah.
And it's one that you have to ask. So if you're not talking to us and you're talking to another organization, please take the time and say, how long is my money in there for? Because there are some instances where there's alternative investments out there that are 10, 12, 15-year type commitments.
Absolutely, sure.
And that can be okay if you know what you're going into. But you've got to ensure that you're spending the time and finding out how long this is. So typically with this organization, with Fortress, it's about 2 or 3 years.
So we need to, you're basically saying 2 to 3 years.
And it's determined ahead of time.
So again, going back to what we said earlier, that's part of the investor's due diligence. That if he's saying, you know what, I'm going to put 25K in, I got to make sure that I'm okay with 2 to 3 years.
That's right.
And as we know, some mutual funds or different options of investing, real estate is considered long term.
Yep.
Okay. So is 2 to 3 years typical?
Well, it's a mortgage, right? So you're not, you're essentially debt against the property, which we're securing. It's not that you own it through debt, maybe, if something were to go wrong, but you have a mortgage. So 2 to 3 years, it's a fixed term. So it's set ahead of time. So you're not thinking it might be 2 years, it might be 3 years. It's actually, we know ahead of time when you go in that this one is going to be 2 years or this project is going to be 3 years.
Okay, so again, in the due diligence, we walk in, it's going to be 2 or 3 years, and we know that there's going to be an interest rate that's set, that if the developer doesn't pay, we can power of sale them.
That's correct. And so in this case, if you wanted to add, that return is 8%.
8%. So you're getting 8% for 2 or 3 years.
Depending on the project.
Depending on the project. Because but we also use that magic word, which is, I want a piece of the pie.
Yeah.
And that comes in the end.
That's correct. In this case here, it does. So in addition to having a mortgage, we say we're helping this developer really be able to make the profits on this project.
Sure.
And by the way, these guys are not working with developers that are trying for the first time. Brad Lamb may be a name that some of you have heard of before. He's on, I think it's Big City Broker was that show. He's quite the character. I met him, and he's not much different in real life, I'll tell you that. Okay. Also spent some time with Empire Developments, another big development organization you may have heard of.
Yeah.
And these are the types of companies you're going to deal with. So reputable developer, so we know that they can pay that 8%, but we're helping them make that profit.
Absolutely. We're partners with them in a way.
We're partners, right?
Yeah.
It's a great way of saying it. So yes, we want our 8%, but when it's all done, we want a part of that profitability. And the way that they've worked this here, and while the 8% is fixed, the profitability part isn't. Now, they've got a good idea of where that number is going to come out, meaning how profitable they're going to be.
Okay.
But typically they're paying about a 12%, I think it's a mortgage participation. I'm not sure the exact term for it, but a 12% return at the completion of the project is what they're targeting. Now, if the project makes more money, and it does really well, it could be higher than 12%. If it makes less money, it could be less than 12%.
And so obviously, when you first walk into this, we don't know what the actual profit will be, but at the end of the 2 or 3 years, there's documentation to show that the developer made X amount of dollars, and my 25K gets a portion of that based on the percentage of profit?
That's correct.
Okay.
That's correct.
And in this particular deal, you're saying that you get another 12%?
Yeah, so maybe a way we could put it is year 1, year 2, year 3, and another 12%. So year 1 would be 8% to the investor.
Right.
And that's paid on a quarterly basis.
Okay, there's year 1. And then year 2, you get 8%.
That's right.
I know this is probably not very neat, but, and then year 3, if it goes that long, you get 8%.
If it's a 3-year, it's another 8%. And then on the completion, we're hoping that it's going to be somewhere in that 12% range. In addition to the 8% you had already received that year.
Wow. So from an investor standpoint, you're getting 8%. No matter what, you're going to get 8%. Even if the developer doesn't make any money on it, all he's done is pay out. He's built a project, and basically it's a white elephant. He didn't make any money. I still made 8%.
He essentially has to foreclose before he's going to not be able to pay you the 8%. It's a fixed contract. Okay, so we got to understand that. Now, I want to make something clear because this sounds quite good.
Too good to be true.
Yeah. And it will, because you haven't seen things like this before, so don't be scared that it is too good to be true, but know that there are risks associated as well. And our job as advisors is to ensure that you understand what those are, right?
Okay.
And in some of the cases here, nothing is guaranteed. It's not a GIC. There are some risks associated. I think an organization like this that's been in business for 10 years, though, does a great job of mitigating those potential risks.
Sure, because he wants to make a profit.
Well, that's where they're going to make their money as well. And heck, in my opinion, they're going to do a lot better job than I can. And what do I mean by that? I mean by the individual investor. We know as much as we know about real estate, and we read our books, and we may be very good at it. But oftentimes we don't have a team of 20 people helping us back to make these right decisions.
Excellent point, Ken. I'd like to just sort of cut you off there, but we're going to come right back and talk more about investing in alternative investments and real estate on Your Money and Real Estate.